The stock market is filled with individuals who know the price of everything, but the value of nothing. Philip Fisher. Risk comes from not knowing what you're doing. Warren Buffett. Imagine investing your hard-earned money in something, only to see it disappear overnight. What if that financial decision wiped out years of savings in just a blink? Today, we're diving deep into why you should never invest more than you're willing to lose, and how doing so could be the key to maintaining your financial sanity. In this video, we'll explore one of the most fundamental principles of investing. Don't invest what you are not prepared to lose. Investing, whether in stocks, cryptocurrency, real estate, or any other asset, can bring great rewards, but it also carries risks. It's crucial to understand these risks and how to manage them. If you approach investing with a solid strategy and the right mindset, you can protect yourself from losing it all. 1. Understanding risk and reward. The first concept every investor needs to grasp is the relationship between risk and reward. The higher the potential reward, the higher the risk involved. This principle is essential because it helps investors to make informed decisions. If you're not prepared to lose the money you invest, it's a red flag that you might be taking on more risk than you're comfortable with. Think about investing in tech stocks during a volatile market. While the potential for high returns is there, there's also a risk that the value could plummet overnight, especially in a market downturn. If you can't afford to lose that investment, you might want to reconsider. 2. The importance of diversification. One of the best ways to protect yourself from losing everything is by diversifying your investments. By spreading your money across various asset classes, you reduce the risk of a complete loss. Diversification doesn't eliminate risk, but it significantly lowers the chances of a total financial wipeout. Instead of investing all your money in one tech company, consider investing in a mix of stocks, bonds, real estate, and even some safer options like index funds. This way, if one sector takes a hit, the others might help cushion the blow. 3. The emotional side of investing. Investing isn't just about numbers, it's also about emotions. Fear and greed often cloud judgment, leading investors to take on more risk than they're comfortable with. Being emotionally invested in your assets can skew your decisions, making you more likely to overcommit to a high-risk investment. Think about the frenzy around cryptocurrency in 2017. Many people saw the skyrocketing prices and rushed to invest, only to face significant losses when the market corrected itself. These emotional decisions were made without fully understanding the risks involved. If you're finding this video helpful so far, don't forget to like and subscribe. Also, check out our video titled, "Don't Make These Financial Mistakes," for more insights on how to avoid common pitfalls in the financial world. You can find the link in the description below. 4. Setting financial boundaries. One of the best ways to protect your financial health is by setting clear investment boundaries. Before you invest, decide how much money you're willing to put at risk and stick to it. This mindset allows you to maintain control over your financial future, even if things go south. Suppose you're thinking about investing in an emerging market. Before you do, set a limit. I'm willing to lose up to 5% of my total portfolio on this investment. This boundary helps you manage your exposure and ensures that your investment doesn't negatively affect your overall financial picture. 5. The role of education in risk management. Before you make any investment, it's crucial to educate yourself. Understanding the market, the assets you're investing in, and the potential risks involved can help you avoid financial mistakes. Knowledge empowers you to make better decisions and prepares you for market fluctuations. Before investing in a startup, research the industry trends, the company's business model, and potential challenges. This due diligence will help you assess whether the risk aligns with your financial goals. 6. The danger of over-leveraging. Over-leveraging is when you borrow money to invest, with the hope of amplifying your returns. While this strategy can work in the short term, it also significantly increases your exposure to risk. If the market moves against you, the losses can be catastrophic, especially if you're not prepared to lose that borrowed money. This is why it's crucial to only invest what you can afford to lose without relying on loans or credit. Imagine you take out a loan to invest in real estate, hoping that property values will rise. If the market crashes and the property value falls, you could end up in debt, owing more than the property is worth. This kind of risk is dangerous if you're not prepared to handle it. Market timing and the risk of chasing trends. Trying to time the market, buying when prices are low and selling when they're high, can be tempting, but it's incredibly difficult to do consistently. Most investors who try to time the market end up chasing trends, buying high and selling low. This is often a result of panic or euphoria, both of which lead to decisions driven by emotion rather than logic. During the COVID-19 pandemic, many investors jumped into tech stocks because they saw immediate gains. However, when the market corrected, many of those investors found themselves stuck holding overvalued assets. If you invest based on trends without understanding the underlying value, you're essentially gambling rather than investing. When it comes to investing, one golden rule stands above all: never put in more than you're willing to lose. This principle isn't just a cautionary tale, it's a survival guide in the often unpredictable world of finance. Markets can be volatile, and even the most well-researched investments come with risks. Whether you're trading stocks, diving into cryptocurrency, or exploring real estate, there are no guarantees of success. By only investing money you can afford to part with, you shield yourself from financial devastation and maintain the flexibility to navigate life's other expenses. Beyond finances, this mindset cultivates emotional resilience. Investing with money you can't afford to lose often leads to stress, panic selling, and hasty decisions during downturns. On the other hand, a measured approach lets you remain objective, even during market turbulence. This strategy helps you stay focused on long-term goals and avoid rash actions driven by fear. Remember, investments should enhance your life, not jeopardize your financial stability. Always proceed with caution and align your risk tolerance with your financial situation. As you can see, investing only what you're prepared to lose is the cornerstone of a sound financial strategy. When you understand risk, embrace diversification, and stay emotionally detached, you're setting yourself up for long-term success. But this is just the beginning. In the next video, don't make these financial mistakes. We'll dive deeper into the common errors that even seasoned investors make and how you can avoid them to safeguard your financial future. You won't want to miss it. Be sure to subscribe and turn on notifications so you won't miss out on the crucial lessons in our next video. If you haven't already, check out Don't Make These Financial Mistakes to learn even more about securing your financial future. This video is for informational purposes only and does not constitute financial advice. Always do your own research and consult with a professional before making any investment decisions.